I'm in New York City on a beautiful summer's morning. I'm in Central Park, which is arguably the most loved, most used and most cosmopolitan piece of public urban space in the world. It's 836 acres, 250 are lawns, 150 is underwater, ponds, lakes, etc. And there's 80 acres of woodlands. The locals I speak to say that Central Park has never been in such fine shape, which is in sharp contrast to the state of the US economy. The US economy, it's nothing new to say that it's running twin deficits, the budget deficit and the current account deficit. And what about the 17 trillion of national public debt? It's almost 17 trillion anyway, it doesn't matter. What's a trillion here and there between friends? And the US Federal Reserve? Well, the US Federal Reserve has a massively expanding balance sheet, a balance sheet that is laden with the debt of its own country. Does it all matter while the US is the world's biggest economy and while it controls the printing presses? Probably not, but we're going to find out.
In November 2008, just a few months after the collapse of Lehman Brothers, the US Federal Reserve introduced QE1, the first in what became a series of quantitative easing programs. It involved the Fed spending $100 billion per month to purchase mortgage-backed securities. It lasted 17 months, with a total spend of $1.7 trillion. In November 2010, the Fed introduced QE2, which lasted 7 months, with $85 billion spent on US Treasuries per month. A year after QE2 concluded, the Fed went even further by introducing, yes, you've guessed it, QE3. In a move seen by many as controversial, this program included a clause stating that a further purchasing of mortgage-backed securities and treasuries would go indefinitely, with no limit to purchases. The degree of spending remained static at $85 billion per month. Quantitative easing ran in tandem with Operation Twist, and quite aptly named, this introduced a different dynamic. Short-term treasuries were sold by the Fed, the proceeds of which were used to buy up longer-term securities. In January 2013, changes were made to QE3's structure, evolving it into what's now commonly referred to as QE4. Operation Twist had come to an end by this time. The Fed was to target the unemployment rate directly. QE4 would continue until this rate fell below 6.5% or until core inflation rose to 2.5%.
Over the next hour, we're going to talk to business leaders, to economists, to traders, to ex-traders, to academics, maybe even try and find a politician or two, who knows. But we're going to try and find out if money grows on trees. In Central Park, as you can see, quite a lot of trees. In fact, there's 24,000 of them. 1,700 of them are American elms, and they're looking particularly fantastic at this time of year. But there's no money trees. They're elsewhere. Let's find out if money really does grow on trees.
Government monetary policy occasionally used to increase the money supply by buying government securities or other securities from the market. Quantitative easing increases the money supply by flooding financial institutions with capital in an effort to promote increased lending and liquidity. Trying to understand quantitative easing seems simple enough on the surface, but scratch a little deeper and you'll find a slew of different opinions, with some for it, some against it, and some who just sit on the fence. Of course, everyone with even a hint of interest in the US economy has a view, albeit controversial at times, on the Fed's policies. Lee Adler, founder and publisher of the Wall Street Examiner, says it's all about looking at the data, blocking out what the pundits say, and finding out the facts.
Tell me about quantitative easing, tell me about printing money, and tell me about money growing on trees. What's it all about?
Well, all of the central banks are moving in the same direction at the same time. They're dealing with the same banks, the same clients all over the world. They are pushing policy in a direction that they've never gone before, where they're focusing on the direction of equities rather than the money markets themselves. And when you look at, for example, the 21 primary dealers that deal with the Fed, only 7 of them are U.S. banks. 7 are European banks. 4, I believe, are Canadian banks, 3 are Japanese banks, and they're the same banks that are dealing with the ECB and the Bank of Japan and the Fed. So it's all one liquidity pool. The central banks are pumping liquidity into these institutions, and they decide where it's going to go. Is it going to go into Japan? Is it going to go into the U.S. Treasury market? Is it going to go into Europe? Is it going to go into commodities? Or is it going to go into U.S. equities? And I think the answer is that the central banks are pushing, in particular, Ben Bernanke is pushing them to go into U.S. equities. That's where he wants it to go.
Who are these primary dealers?
Primary dealers are those very special banks and dealers that are selected by the Federal Reserve to transact trades with the Fed. The Fed conducts monetary policy by trading with these 21 dealers that have to meet certain criteria. And they include Goldman Sachs and JPM and Societe Generale and BNP Paribas and Mizuho and Daiwa and RBC, the Royal Bank of Canada, RBS, Scotland. All of these banks are worldwide organizations. They are operating in all markets. And as I said, only 7 of them are U.S. banks. So when Fed policy goes out, it goes out to the entire world, not just to the U.S. market. By the same token, the ECB, when it conducts business with the banks that it deals with, and when the BOJ pumps money into its system, it's going into the same banks. They decide where they're going to put that capital.
Lee Adler, publisher of the Wall Street Examiner, says the Fed's policy is a series of long-term serial blunders. But because they take so long to play out, in normal human terms, we don't see them as blunders immediately.
Those of us that have some common sense might look at this and say, this is insane. They're trying to rig the markets and get a certain outcome from it. Normal people would look at it and see it as insane, but the policymakers are inside the bubble. They believe that what they're going to do will work. They believe in the theories. When it will stop working, that's a good question, and part of my job is to try to analyze the trend as it unfolds to see when the cracks are beginning to appear in the facade, where we might be getting to that point where things are going to come apart.
So again, I'm gleaning from you that this is very good for asset bubbles, very good for a very tiny percentage of the world, i.e. the masters of the financial services universe, but not that great for Main Street.
It's good for asset bubbles, and to the extent that 7% of the people hold all of the assets, as long as they manage to push the bubble up, it's good for the 7%. But everybody else is struggling because the corporate structures have learned that the way to increase profitability is to squeeze labor. There's no support for labor anymore. So the middle class basically is being decimated. It's disappearing. More and more people are falling out of the middle class and into the lower social strata. So their life becomes a matter of subsistence. They're not playing this game anymore. The policymakers are hoping that the 7% will spend so much money at Tiffany's and on their world trips, their world shopping trips, that they'll keep the game going and keep the masses employed at a subsistence level. But beyond that, how long they can keep the game going, I don't have that answer.
And while the world's economies anticipate the return of normalization, the question about the accessibility of money still hangs in the air. Does money grow on trees?
It's easier than money growing on trees. The Fed literally says, poof, I'm putting this money into your account. It didn't exist before, but here it is now. I'm buying these bonds from you, Mr. Primary Dealer, and I'm paying for it by actually putting $10 billion into your trading account here at the Federal Reserve. What you do with it from here is up to you.